Welcome to this webinar, another webinar in our series on business finance. And today we're going to talk about impairments and impairment and credit losses. Just before we start, of course, I need to inform you, as we have done with the previous webinars that we had, that we will record this session. So if you have any sort of legal limitations or whatever it is for that, I have to ask you to log out so you don't get into any kind of problems regarding that. But apart from that, we will be running as usual with no other obligations coming into play. So just that you're aware that we're recording this session. Very good. Then let's see if we will have the... As I said, the first slide is up. So we are going to talk about impairments and credit losses in the light of COVID-19. So sort of the plan here is very much to focus on how do we measure impairment and credit losses and what kind of effects do we see from that. Also trying to take a little look at the observations that we have so far with respect to impairments, generally speaking, and credit losses as well in the banks as an effect of this, and then trying to build a little round off on that topic at the end of everything. So interesting observations, of course, what we've had, taking once again, as we did last time, from Svenska Dagbladet, where we can see is the bank's credit losses so far is approximately 6 billion Swedish crowns in total. But this is also the only thing that we fundamentally have seen anything about. We haven't really talked about general impairments, generally speaking. So these are the headlines that have sort of made it to the papers so far. And that is an interesting observation in its own right, of course. I'm not saying that it's strange that we see the credit losses in the banks, given the situation that we have. Before we see any kind of impairments, which we will discuss later on as well. But this is what we've seen. This is the fundamentals for the Swedish sort of observations. And we will come back a little bit more into the detail of that later on when we round off this webinar. First of all, we do have a couple of questions for you regarding your own observations, because of course what makes the headlines in the papers is not necessarily the same thing as you observe out there in the companies, because we cannot follow up, of course, as the headlines proceed. So we do have a couple of questions for you. The first one come up here, which relates to your company. If you have made any impairments, of course, if you're in the banks, any kind of credit losses, reservations yet, and you do have three options here. Yes, large ones, yes, some, or none. So please give us some input regarding your situation. Some responses here at least. Let's see where, yeah. We see here that we've had none has sort of yet made any large ones. Of course, there's a definition what we mean by large ones at the end of the day. But some, and about 60% of the answers that we do have, and 40% are none of those. Of course, from this question, we don't know whether we're talking about impairments or credit losses yet. So I would assume that we are mostly talking about credit losses here, but that sort of remains to be thought of and discussed in more detail. So we're going to look a little bit more into the future of that with a couple of additional questions here. So we're first going to look at the impairments. And now we sort of disregard the credit loss side here. So just generally thinking about impairments and expectations for the future is the next question you will have. So do you believe we will see impairments in the future? Yes, large ones. And now we're talking about sort of impairments of other assets than the credit portfolios. Large ones, some, or none. So please give us some feedback on this one here. Seems like it's ticking in some answers here. I have some vague feeling for what it's going to be. Yeah, we have a 2080 response here. Everyone says that yes, we do believe that there will be impairments in the future generally. 80% of you say some, and a few of you are slightly more negative than that. Yes, we will have large ones in the future. This is interesting because it seems to be sort of slightly, if we put it, conservative on the impairments. That means sort of not so conservative in terms of measurement, really. So let's pose the same question with respect to credit losses and sort of see what we're looking about then. Note then that we're talking not only about the banks, because we can of course have credit losses in also the other kinds of companies that we do have, both in the service industry and manufacturing side, of course. So big time credit losses in the future. Yes, large ones, some, and none. We do the same thing as we did with the other one. Okay, so we close this one, and few of you actually say none, some of you, but most of you are into the yes some or yes large ones, and here we see a little bit more on the large ones coming in, which probably is not surprising because this is all about sort of paying in the future rather than sort of impairing the values of assets. So I'm not entirely surprised about this. But it makes some sense that your perception and my perception of what we're talking about seems relatively in line. So thank you very much for giving us this input, and that sort of allows us to proceed into the presentations here, which we will continue then until approximately 1:30, and then we will have some general discussion. So the agenda here, the introduction, now that we have had, we will sort of talking a little bit, generally speaking, about balance sheet valuation in general, so we know what we're talking about, sort of just in the big framework of things, talking about impairments in relation to individual assets, talking then more about cash generating units and thereby coming into the issue of goodwill and goodwill impairments and what we would expect to see there given the structure and so forth, problems and issues with respect to that one. We will then comment briefly also on the financial instruments and the credit portfolios. What do the credit loss accounting look like, and what do we expect to see from that? Then we're going to make some observations and reflections about the future. Sort of what do we see, what kind of things have we seen so far, for example, and what can we believe about that in the future? And then after 1:30, somewhere slightly after that, we will round off with the breakouts, with discussions of your observations, and then we will get back in together again for summary and joint discussions for those of you who like to continue through the entire webinar until 2 o'clock. So that is sort of the plan. So generally speaking, what we're talking about here with balance sheets, because we're talking about assets, we're talking about values of assets. And of course, we do have a couple of alternatives. We should not frame it as alternatives, perhaps, but different assets are measured in different ways. And some of those are sort of applicable, generally speaking, to different kinds of assets. The first one that we do have is that we measure at a lower of costs and net realizable value. And when we're talking about the net realizable value, we're talking about net selling prices normally. So the lower of what we purchase the assets for and sort of what we can sell it for, deducted with the selling expenses that we do have. This kind of approach is, of course, normally used for current assets of various kinds, which are not financial assets. These are sort of not sort of problematic or not relevant when we're talking about impairments, because this is sort of just the valuation approach that we do have, and it sort of handles any value fluctuations. Then we do have acquisition costs, less accumulated depreciation / amortizations, and any kind of impairments. Then we're talking about normal fixed assets, such as buildings, land, machinery, equipment, these kind of things. And of course, they have their starting point in the acquisition cost, and then we normally depreciate it or amortize them over its useful life. However, occasionally there, when we do have value losses, we do have impairments, which we will recognize, well, then which will hit the income statement as a result of that. So these kind of assets, sort of the traditional fixed assets, they are sort of into this impairment testing kind of approach that we do have. Then we do have certain assets that are sort of carried at fair value. And the most important categories then that we're talking about, that is some part of our financial instruments, which we trade continuously. These are carried at fair value, normally approximately market value. We do have investment properties, so buildings that we have for renting out effectively. And we do have biological assets, which should be carried at sort of fair value as the starting point. And these are sort of the main categories that we are referring to, with some exceptions on the other ones. Since we are talking about constantly measuring at fair value, it means that the impairment situation is not really relevant for these assets either, because it fluctuates with the fair value fluctuations generally, and that is not sort of an impairment situation. Then the final approach we have, it is sort of the amortized cost approach, where we do use the effective interest rate method. This is used for financial instruments, and particularly debt instruments are we talking about, where we're basically looking at the future cash flows of the debt instruments, and that one is then managed with the effective interest rate, i.e. the discount rate that sort of gets us initially to basically the acquisition cost or the fair value of the instrument once it was issued or bought as a starting point. And that is sort of the fundamental of what the amortized cost approach is, which then is used, as we said, for debt instruments. So these are the four relevant ones. So, and when we are talking about impairments, we're talking about the second and the fourth one, because that is sort of when we're making credit losses, which is a type in a way of impairments that we're referring to. So that's the credit losses dimension. And effectively what we do, of course, just sort of to refresh our minds, is to say when we do have reductions in value on the asset side, of course, it immediately hit the equity side. So it becomes sort of expenses on the income statement, which then is sort of looped in to the equity component. So reductions in value, one-offs, that is what we're referring to when we're talking about impairments. Good. So let us then first start thinking about what does the impairment model really looks like? The general approach to impairments. So how do we look upon that? Well, what we do is that we are looking at a comparison between the carrying value of the asset, i.e. what is the value on the balance sheet. And that might be acquisition cost less sort of the depreciation or amortizations that we've done in the past. And then we're comparing this to the recoverable amount. And the recoverable amount is intended to be sort of what we can get from using it or selling it, fundamentally. And if the recoverable amount is lower than the carrying value, that means that we need to make an impairment. So the recoverable amount then is made up of the fair value, less sort of any cost of disposal, i.e. what do we get net from selling it? Or, as another approach, the value in use, i.e. what sort of kind of benefit, what kind of values do we have from just using the asset by ourselves, which is basically a discounted cash flow approach when we're talking about the value in use. And then we're going to focus on the higher of the two, because we assume that the user of the asset is going to make the best use out of the particular asset. So sort of just putting some numbers of those, if we assume that we do have a carrying value on a particular asset, that is 100. We have a fair value, less cost of disposal of 60, and a value in use of 80. Then the recoverable amount here is actually 80 in this case. And since the recoverable amount in that particular case is actually lower than the carrying value, we need to make an impairment of 20. That 20 is then sort of what hits the income statement and what reduces the value on the balance sheet of the particular asset and, as an effect, the equity. That is sort of the general structure of what we're talking about. So that one goes sort of for all the kind of assets that we are managing and sort of measuring with respect to the acquisition cost less depreciation and amortization. The question then is, of course, what happens with goodwill, which is a very particular kind of asset. Sort of the goodwill is, generally speaking, a residual to start with. So when we acquire another firm, we obtain goodwill as a result of what we paid for it and what all of the other assets and liabilities were actually worth, i.e. a residual by definition. And the fundamental approach for impairment testing on goodwill follows the same kind of logic as we had on the previous slide for any other kinds of assets, fundamentally as a starting point. The major difference, as we said, is, of course, that goodwill is residual, and it's also evaluated and tested on a cash-generating unit level. And that is sort of a combination of assets rather than anything else, which is due to the fact that goodwill is a residual to start with. So a cash-generating unit, then, is the smallest identifiable group of assets that generates cash flow that are largely independent from other assets or group of assets, and those cash flows generated by those. So we kind of need to separate that one out. The question is, of course, in practice, what does that mean, and how low can we actually go? This should be the smallest one, but of course, this is up to discretion at the end of the day. The recoverable amount then of the goodwill, which should we compare? Well, that is sort of the fair value of the value in use of the CGU, less the carrying value of all of the other assets in that CGU, i.e. we bring out the recoverable amount of the goodwill as a residual from the calculations of the total CGU as an effect of that. And this, of course, brings some kind of issues to us. But let us look at a tiny little example to just sort of get our minds around what is happening here. Let us take as a starting point here a balance sheet that has goodwill of 200 and other operating net assets of 300. Just a starting point. Before we have any kind of value losses, the fair value, the value in use, is in total 900, made up of the goodwill, having a fair value of 300, and other operating net assets of value of 600. Just an assumption. That is sort of the starting point. Then we do have a sudden value drop in this. And that value drop, if we theoretically can look at this on a separate basis, we would have other operating net assets that we have identified a value of 500 and goodwill of 150, if we could separate them out. However, what will now happen to our impairment test on goodwill? Well, we need to sort of calculate our recoverable amount on this one. And let's see here now. As a matter of fact, that value, it's an incorrect value there. It should be that it's only 400 on the other operating net assets and 550 in total. Then we do have 550 minus 300. Sorry about that. I will correct that one. Which then gives us a value of 250 in total. In that situation, we will have no goodwill because the recoverable amount of it all is actually lower, it's higher than the carrying value of 200. So we will see no impairment of the goodwill anyhow, despite the fact that we are sort of referring to decrease in the value over there. So there is an issue with that calculation. It should be 350 at the bottom there, or changing the values. But still, the conclusion is the same. We will not get any impairments on the goodwill as it stands. And that's important to remember, despite the fact that we will have had a decrease in the goodwill measure if we sort of could have calculated separately. And this is sort of a little bit of a problem. So the impairments on goodwill, what we can see there is that the goodwill is actually protected by the unrecognized value of the other assets. i.e., it's not that easy to get an impairment of goodwill, even though the value is actually decreased. So that also means the goodwill effectively measures something else than the originally acquired goodwill, i.e., captures the other ones. And as a result of that, any kind of impairments of goodwill is actually delayed due to this. And that is sort of an issue that is a little bit problematic. What we then see in addition to this is that we do have an issue, of course, of management discretion with respect to the calculation of recoverable amount, as long as we're using value in use, because then we are looking at expectations about the future, which of course is based on management expectations at the start. So the problem that we have seen, and we've seen in the past crisis, is that we in a way see too little and sort of too late impairments of goodwill, generally speaking. And the big question now, when we're looking at the COVID-19 situation, the crisis that we do have now, the question is this crisis going to be sufficiently severe in order to trigger goodwill impairments? I mean, so far, we have not seen anything about that. And the question is, how prolonged do the crisis need to be in order to see any major effects on the valuation of goodwill, and thereby if we're going to see any major impairments coming along the line? It's very hard to say, but the indications of what we see, and when we sort of evaluate this from a theoretical point of view, it seems like, well, we should not be too sure of that unless we have a very prolonged situation. When we're now thinking about the credit losses, in the past, in previous crises, what we did have was the IAS 39 standard. That one was based on an incurred losses approach. That one fundamentally said that we need to have a loss event that had to have occurred that would then trigger any kind of credit losses. One of the major arguments then, when we abandoned IAS 39 a couple of years back, was that it was pro-cyclical in nature, i.e., once sort of we actually took the credit losses, well, not until the incurred losses, the losses actually had occurred. And the thing is then, of course, when things start getting bad, and that is when we actually start measuring losses and thereby having credit losses on our income statement, that sort of just made the situation even worse. And that was kind of the problem that we actually saw. What we do have now with IFRS 9, that's based on expected losses. So that one means that we're looking at the expected future cash flows, and we should see if we expect to have lower cash flows coming in the future, and that will sort of trigger a situation where we're going to make impairments, or then account for credit losses, generally speaking. This has no reference sort of to the fact that we have an incurred situation, i.e. a loss event that's taking place, but we're just going to make forecasts about those future cash flows. When we are talking about sort of these debt instruments, which we are going to evaluate for impairments, we are fundamentally having 3 stages in the credit portfolio: stage 1, stage 2, and stage 3. When we do have our debt instruments, they do start up in the first stage. And in the first stage, we are evaluating whether we do expect to have any losses during the coming 12 months. That is sort of the base case for any kind of debt instruments that we do put up on our balance sheets, the asset side of that, i.e. loans, for example, for banks. Then in the second stage, when sort of the debt migrates to stage 2, which then is a higher level, then we're suddenly starting to make calculations of lifetime expected losses. losses. The same holds true in stage 3, but what we also are now talking about is when these are actually credit impaired, which effectively is to say we have strong indications that we're effectively not going to get paid. Sort of we are long overdue, people are long overdue with the payments, for example. That's an indication when the debt actually becomes credit impaired. What is then actually happening here, since we're starting up in stage 1, it is that when we do have changes in the credit risk, and what we're referring to then is sort of what we're talking about, the probability of the default. When that probability increases significantly, that is sort of when we move from one stage to another stage. So when the probability of default increases from our original point in stage 1, and then it increases, then we're going to move it to at least stage 2. But if it's also the situation that we sort of have the payments are long overdue, for example, then we're actually moving it into the credit impaired situation. And since we are moving from a short period of time, which we're going to calculate expected losses, to a longer period of time, it's also natural that the total expected losses that we see will actually increase, and sort of course, also we have an increase in the probability of default, and the multiplicative effect here, of course, increases the credit losses over time. And this is fundamentally how we think about the situations. Another couple of observations that we need to make with respect to the credit losses is that we should also take into consideration loan commitments, and they should be included in the credit loss calculations. It's not only the loans that the banks have outstanding and that are shown on the balance sheet, but also the commitments that are off balance sheet. They are also included in the calculations of credit losses. And of course, in times of crisis, it is not sort of completely unreasonable in the situation that we are, that the loan commitments are probably increasing. And as a result of that, of course, it also makes sense that we could see increased credit losses as a result of that. So it's not only the existing loans per se, but also the commitments that were actually made that sort of particularly can increase the situation. A fundamental question that we do have is, do we believe that the change from IAS 39 to IFRS 9 actually results or has resulted in less procyclicality? I think that that is a question that we sort of need to think a little bit about. And there are sort of some indications to say that maybe it's not fully the case. And the situation is, of course, doubtful because it's simply hard to predict these major downturns that we see. It was not exactly the case that everyone would say, oh, we're going to have a COVID-19 crisis in a couple of months, and thereby we should start taking credit losses as a result of that. No, of course not. It just hits us. So given the fact that it's very hard to predict these major downturns and crises that actually takes place, the question becomes the expectedness of it, and when it actually starts to occur, the difference in time, of course, potentially becomes smaller and smaller, and as a matter of fact, smaller than we would have liked in order to take away the procyclicality effect of things. Of course, I shouldn't say anything else, because maybe it's actually somewhat earlier in the cycle that we now start seeing these kind of effects, rather than we actually have sort of closed cases, if we put it like that, with respect to limits in the cash flows that are actually showing up. What is, though, interesting here is as well that the institutions with the standards ISB, for example, they have sort of clarified their interpretations. And a little bit as an outcome of that is that you should be a bit careful in calculating the credit losses. So we really think about if this is sort of a short-term effect, maybe you won't have as much an effect as you otherwise would have. So we're not overestimating credit losses. And we have other institutions as well that have been sort of out and talking in the same kind of situation. And it is tempting to interpret that as an attempt to sort of reduce the pro-cyclical situation that potentially could emerge as a result of that. So, generally speaking, let's think about some observations then about the impairments. Impairments, generally speaking, they are, of course, no cash flow today. And we see that when we're making valuations, of course, people start saying we should use EBITDAs, for example. We should take out depreciation, amortizations, but also impairments from our calculations. However, of course, if we're thinking about the impairments that could actually be seen, we have made investments in the past, which means that there have been cash flows in the past. Those cash flows, of course, they include hopes and expectations about the future once we did it, because they were all expected to be positive NPV investments. So that is, there has been cash flows, but they were also expected to be cash flows, as we said. And an impairment means that the present value of expected future cash flows, they are actually lower than what can be supported by the carrying value. I.e., that means that the expected future cash flows, they have actually decreased. And that is interesting in its own right, because what we are talking about then, of course, is that the impairments is, of course, a very clear indication of future cash flows, and therefore extremely important in terms of valuation, even though, in a way, it sometimes seems to be trying to neglect that. So impairments, they are actually surrounded by cash flows in all directions, but so the cash flows do not normally occur or do not occur in the particular period when we see those. So let us take a look at some of the empirical observations, generally speaking, with respect to impairments, etc. So no, we have basically seen no conventional impairments on assets so far. And that goes, of course, for Goodwill as well. So that is sort of the starting point. None of that has actually emerged, more or less, in the big companies that we do have. What we have seen, though, is that we've seen some decreases in fair value with some investment properties. Few observations of those we have actually seen, but sort of not on a general basis like that. Credit losses, on the other hand, they have actually started to emerge. And that is not surprising, because we are sort of directly referring to the expected cash flows in a shorter period of time as well, which should have a closer effect, but to a varying degree. When we're looking at the Swedish big four banks here that we're talking about, we said that we had approximately 6 billion SEK. And that is an increase by approximately 4.6 billion SEK compared to what we had in Q1 2019. So of course it is a big difference that we see, and these credit losses are actually starting to show up. So the question then is, what does it look like internationally? And I've just looked at a couple of them just to give you a feeling for them. I try to calculate them over to Swedish crowns. Very rough estimates that we're talking about. So Barclays having approximately 25 billion SEK by themselves. The Royal Bank of Scotland about 10 billion SEK. The Citigroup calculated to 62 billion SEK. Of course, very little realized, but very much looking into the future and sort of reservations for future non-coming cash flows. Wells Fargo, 37 billion SEK. So that is a little bit of an indication of where we are. And as we pointed out in the next but last bullet point there, the majority of these credit losses, they are actually expectations of future events. So it hasn't really shown up yet, but they will in the future. So the question now, of course, becomes, is this only the beginning? And most likely it's not. I do believe that every one of us are sort of with some kind of almost being scared, looking ahead to the release of the Q2 reports, when sort of the real effects of what has happened so far will emerge. And that is, to me, sort of when we start to see the big consequences of things. Of course, the banks are a little bit ahead of that, but I wouldn't be surprised if we have more to expect coming in the quarters to come, at least as long as the situation prolongs. It's also going to be interesting to, of course, to follow here, because it's likely, of course, that those countries where we have sort of stronger shutdowns, that we also will see bigger hits. And we see pretty big numbers, of course, if we look internationally at the examples that we do have here. And of course, it's likely now starting up long processes in order to start up again after the shutdowns, that we also should have reasonably larger credit losses coming into the future. So it's going to be really interesting to follow the coming quarters with respect to these issues. But the sort of the outlooks, at least from my perspective, I have to be a little bit pessimistic about the outcomes. To see. Very good. We have passed 1:30. So we are going to have a little breakout now for those of you who want to stay and join for some kind of discussions. So your observations, your thoughts about impairment, credit losses going into the future and the implications of that, we would like to have some discussions on. So we will form some groups for those of you who want to stay and discuss that matter. And then sort of we will round this one off with having sort of a short observation and reflections and sharing a little bit at the end. So we will sort of send you out into breakouts and groups for those of you who remain. And the rest of you, thank you very much for joining us and thinking and talking a little bit about the observations and the structure of what we've seen. So thank you very much. And for the rest of you, please join the breakouts.